Rule number one, never lose money. Rule number two, never forget rule number one. Whenever you hear this quote, you think that never let your investment go down. But that is not actually what it means. Even the greatest investors have seen their portfolio go down billions of dollars during market crashes. So, what does never lose money really mean? Imagine two investors. One is chasing the next hot stock. He is buying because everyone else is buying. He ignores risk, overpays, and believes that the price will always keep on rising. The second investor is patient. He studies businesses. He waits for a fair price and invests when the odds are in his favor. 10 years later, one investor is still trying to recover his losses, whereas other has quietly built wealth. The difference isn't intelligence. The difference is understanding one simple rule. Protect your money first. Profit comes second. Because once you lose large part of your capital, the journey back becomes incredibly difficult. In this video, we will uncover what never lose money means and how following this one principle can completely change the way you invest. Avoiding losses is more important than chasing high returns. You enter stock market asking one question: how much money can I make? But successful investors ask a completely different question: how much money can I lose? That small change in thinking makes all the difference. Imagine two investors. The first investor earns spectacular 50% return in 1 year. Excited by his success, he takes even bigger risk. And then finally, one bad investment wipes out huge part of his portfolio. Second investor never earns extraordinary returns. Instead, he consistently protects his money by avoiding poor businesses, overvalued stocks, emotional decisions. His returns are steady, but year after year, his wealth keeps on growing. Who wins in the long run? Obviously, second investor. Because investing is not a 100-meter sprint, it is a marathon. The biggest enemy of wealth isn't earning a little less, it is suffering a massive loss. When you lose money, you are not losing today's wealth, you are losing future compounding which the money could have generated. That is why great investors spend more time managing risk and not chasing returns. They know if they protect their capital, opportunities will always come again. But if they destroy capital, they may never get another chance. The goal isn't to become rich overnight. The goal is to stay in the game long enough for compounding to make you rich. 50% loss requires 100% gain to break even. Imagine you have invested 10 lakh rupees in stock market and that one bad investment has caused the 10 lakh rupees to become 5 lakh rupees, a loss of 5 lakh rupees, which is 50% loss. Most people will say you will need 50% to recover and become 10 lakh rupees, but that is not true. 50% of 5 lakh rupees is 2.5 lakh rupees. So the amount will become 7.5 lakh. You require 5 lakh rupees more to become 10 lakh. That means you require 100% gain to break even. That is why losses are so dangerous. One small mistake can cost you years of progress. The bigger the loss, the harder the recovery. That is why great investors never ask how much can I make. They ask how can I avoid losing big. Because protecting your capital is far easier than rebuilding it. The power of protecting capital. You are playing a cricket match. You don't have to hit 6 every ball to win. Because if you lose your wicket on the very first ball, the match is almost over. Investing works the same way. Money is your wicket. You have to protect it first. Growing it comes later. You spend all your time searching for the next stock that can double or triple. Very few spend time asking what could go wrong. This simple question can save you from disaster. When you protect your capital, something amazing happens. You stay in the game. You survive market crashes. You have cash to buy great companies when everyone else is panicking. You give compounding enough time to work its magic. Great investors become rich not by finding hundreds of miracle stock. They become successful by avoiding catastrophic mistakes. Making 15% a year for a decade is far more powerful than making 100% in 1 year and losing 60% in the second year. The stock market always gives you another opportunity, but only if you have money to invest. That is why protecting your capital is not being fearful, it is intelligence. Remember this, return creates wealth, but protecting your capital keeps you alive long enough to enjoy the wealth. Avoid investing in businesses you do not understand. Imagine someone offer you a chance to buy 10% of a business. Before investing, wouldn't you ask a question? How does this business make money? Who are its customers? What are the risks? Will people still need this product 10 years from now? But in stock market, you skip this question. You buy a stock simply because your friend recommended it, a YouTube recommended it, or it is trending on the social media. That's not investing, that's gambling. If you can't explain in simple words how a company makes money, you probably shouldn't invest in that company. If you understand banking, you may be comfortable investing in a bank. If you understand consumer products, you may be able to evaluate companies that sells everyday products. But if a business is so complex that you do not understand its products, risk or future, it's okay to say I will pass. Great investors do not invest in everything. They wait patiently for the opportunity they understand. You only need to swing when the opportunity is clearly in your zone. The easiest way to avoid losing money is simple. Do not invest in companies you do not understand. Never invest because of FOMO or social media hype. Imagine you're standing outside a shop and a crowd starts running towards it and people are shouting, buy now or you will miss out. You don't even know if it's worth buying. Because everyone else is running, you start running too. That's exactly what FOMO, fear of missing out, looks like in the stock market. A stock starts rising, social media is full of screenshots of huge profits. Financial influencers call it the next multi-bagger. WhatsApp group says last chance to buy. At that moment, logic disappears, emotions take over. You buy not because you understand the business. You buy because you do not want to feel left behind. The problem is that by the time everyone is talking about the stock, much of the excitement is already reflected in its price. And when the hype fades away, many late investors are left holding losses. Successful investors think differently. They don't ask what everyone else is buying. They ask, is this business worth buying at this price? If the answer is no, they walk away, no matter how much popular the stock is. Remember, crowds are driven by emotions. Great investors are driven by discipline. Never let social media make your investment decision, because trends may come and go, but the money that you have lost may take years to recover. Diversify, but don't buy too many poor quality companies. You misunderstand diversification. You think the secret to reducing risk is buying as many stock as possible. So you own 30, 40 or 50 companies. But the question is, if you own 50 weak businesses, are you really safe? If every boat has a hole in it, Owning many boats won't make you safe. You will still sink. Now imagine you own 5 strong, well-built boats. Your chances of reaching your destinations are much higher. The same principle applies to investing. Diversification is about reducing risk that one bad investment destroys your portfolio. It's not an excuse to buy every stock you come across. Great investors do not collect stock like stamps. They carefully choose a handful of high quality businesses with strong profits, trustworthy management, and durable competitive advantage. The best portfolio is not the one with most of the stocks. It is the one filled with the businesses you understand, trust, and are happy to own for many years. Your first job as an investor is not to make more money, it is to protect the money that you already have. Because once your capital is safe, time, patience, and compounding can do the rest.